Jim Cramer discusses how bullish believers are getting rewarded with record highs. The Wall Street tug-of-war has a clear favorite. If you're on the bull side, history shows you always get the benefit of the doubt.
Trust the market. They want to find reasons not to like stocks, and they're willing to go to great lengths to find them. Sell, 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 sell. You can see it on a day like today, one that started very negative and then rebounded slowly. Dow ultimately finishing up 144 points, S&P advancing 0.58%, and then Nasdaq climbing 0.89%. Wow, that was terrific. Now, I spend a huge amount of time in how to make money in any market talking about how you need to trust the stock market. You need to believe in it to invest. If you don't, you'll constantly get scared away at exactly the wrong time. Habitually buy high and then selling low. And that's, I think, why so few people actually build wealth in the stock market. So let's talk about the doubts that drive people away from being good investors using today as a reference point. Now, what I want to do, I'm going to tick down the objections raised by intelligent people that make you feel like a chump for owning individual stocks. And they do, particularly rich people, by the way. Let's go through the steeplechase of October, right up until this morning. First, we're on day 23 of a government shutdown. Go back to the beginning of the month. What was the rhetoric of the moment? It was simple. While shutdowns historically haven't meant anything to the stock market, we were told this time, would somehow be different. Why? Because of President Trump. Meaning that because of President Trump, the shutdown would be bad for stocks. What happened? Well, the market's been fine. It hasn't been hurt by a lack of economic data. It hasn't been crushed by what could happen if hundreds of thousands of federal workers stay furloughed. Unless you work for the government, you might not even know what's going on. That may be unfair, but it's true. Again, historically, these shutdowns simply don't matter to the market. If anything, they've been a positive catalyst for stock, as crazy as that seems. The one problem is we haven't been getting a lot of government data. Tomorrow, we're going to get the CPI, the Consumer Price Index. Now, interest rates went up today, I think, in preparation for a bad CPI tomorrow. If it indeed is too hot, there will be another set of people who are going to come on our air, and they're going to tell you to sell because of the CPI. Do me a favor. Don't listen to them. Second, hardly a day goes by when the president doesn't threaten or cajole or express frustration with China. Every time he says something, it's front page. It's almost always negative. I mean, people shake. The media makes it sound like it's heightened tensions with China, economic catastrophe. There's a whole host of hedge fund managers eager to tell you this is a perilous time. They're so rich, they don't care about you. They don't. Semis get sold off, even though some are in short supply like Micron or Intel, which reported a fantastic quarter this evening. Those stocks get sold all the time because of China. Look, I don't mean to mock the process of foreign relations. But this is a president who negotiates in many different ways. Usually he takes a hard line that freaks people out and causes them to sell stocks. Sell, sell, sell. But then he compromises and you feel like an idiot for bailing on the market, and now you don't get back in, and there goes all the money that you were hoping to make in the stocks. I've gotten to the point where when I see the market come down because of the president's statements about China, I want to tell you just go buy because it's been a winning strategy the whole way. Third, 9 days ago, we heard the most distinguished banker in the world tell us that we were entering a period of heightened risk where mistakes can and will happen. There have been two big defaults, one of them causing J.P. Morgan to take a $170 million charge. CEO Jamie Dimon said at the time, quote, "I shouldn't say this, but when you see one cockroach, there's probably more. Everyone should be forewarned on this one," end quote. At the same time, there were some other bad loans in the system that dinged a couple of regional banks. It caused a huge firestorm of selling. The regionals, they got crushed. But it turns out there is no cockroach infestation. Looking at the banks that have reported, we're actually seeing some of the fewest defaults as a percentage of loans I can ever recall. Bank of America, Wells Fargo took pains to point that out. So did American Express. Capital One. Look, I'm not trying to give Jamie Dimon a hard time. Let others do that. He's an amazing banker. He's a nice guy. I think it always pays to be vigilant. He's probably right that there'll be eventually other cockroaches. There's always a lot of cockroaches. Like, you know, you can't. Nuclear war's not going to take those guys away. But so far, the rest of the industry looks pretty clean. You know what? I've been thinking. I think, Jamie, it was an ill-advised analogy. Here's what I would say would have been better. Sometimes you just get had. Fourth, we know one thing when we came into this month. Apple stock had become suspect, scary, dangerous. I mean, like, wow. sell, sell, sell. So many experts told us that the iPhone 17 wasn't doing that well. We heard about weak lead times and how this one was just one more iteration in a tired and boring line of phones that nobody really wanted. An analyst from Jefferies on October 3rd downgraded Apple not from a buy to a hold, no, but from a hold to an actual sell, 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 sell. A sell? Saying that anything good about the new phone was already priced in, the expectations were excessive. This downgrade sent chills through any Apple bull. In other words, he was saying even if the numbers were good, it wouldn't matter. I bet that scared a lot of you. Did it scare you? Did you sell the stock because of it? Did you violate my own Apple don't trade it dictum? This week, we started with 3 different firms proclaiming that the iPhone 17 turned out as much bigger hit than anyone thought. Gettable fact. Just had to look at the lines worldwide to see how people were desperate to get their hands in this thing. You just had to listen to the outgoing CEO of T-Mobile when he told you the sales were brisk because of the deal they were offering the 17. Honestly, you just had to try one to see how special it is. Yeah, Apple keeps going higher. Finally, the tariffs. We've had a couple of weeks of earnings season. So far, the tariffs really haven't been that much of a factor, other than the media where we ask everybody about them. I've yet to see a downgrade triggered by the tariffs. It's not that they aren't there. It's just they're not smoot-hauling. If they got baked into share prices months ago, well, you won't even notice. If you sold because of the tariffs, and so many of you did, well, we apologize. Shouldn't have scared you. You need to remember that when the CPI comes out tomorrow, because just in case it's too hot because of the tariffs, you don't sell stocks by mistake. Outside of here, right over here, is a street, okay? It's called Broad Street. 42 years ago, I walked down this street on the way to my job on 55 Broad at Goldman Sachs. The Dow at the time was at 1,000. That was some 45,000 points ago. Do you know what I heard every day back then when I was at 55 Broad Street? I'll tell you what I heard. Oh, what a terrible time to invest. Horrible. Rates are too high. Housing's too expensive. Inflation's still out of control. We had a cowboy actor as a president who didn't know anything about the stock market, and even his own vice president accused him of practicing voodoo economics. So when I started working, I heard the fabled 3 words that I've heard for most of my working life, including from my own lips when I got it wrong, and that is, get out now. Since then, since I first heard get out now, the Dow Jones Industrial Average is going from 1,000 to about 46,000. To many of the people who come on and talk about the market, that rise means absolutely nothing. They treat the market as if we're a coin with a bull on one side and a bear on the other. Doesn't matter that there's history on the bull side. They treat each session as a 50-50 coin flip. But the bottom line, this market is not a bunch of coins to be flipped. It's a collection of companies to be invested in. So do this for me. If you're going to think of the market as a tug of war between the bulls and the bears,